Hi, this is Pete Birchall of Stock Market Alchemy Blogspot. It's been about 6 months since I've done an update here for YouTube. The last update I did was in mid-August 2014, talking about a multiple time frame bearish divergence happening in the stock market that was likely to lead to a significant decline, possibly even a bear market top. And while we did see the biggest decline in stocks in over 2 years from that point, we obviously have pushed to new highs here in the last few months, but we're in a similar position now and actually even more bearishly aligned given the technical analysis in the stock market. So I do feel kind of obliged here to get some content out here and just show people who follow these videos what's going on, because even though it can seem like when you're seeing this just steady, tight uptrend here in the market, and it can seem like technical analysis is broken and there is no legitimate downside in the market, and whether that be due to the Fed or whatever, which I'm sure there's likely a lot of truth to that. The reality is there still is going to be an end to that trend, and when you see the perfect technical alignments and you start seeing divergences and non-confirmations and that type of thing, those are going to be the elements that we're still going to expect to see at the end of a trend whenever that does come. Now, when I look at a market and how I trade a market, I basically operate by a divergence type of theory of the market, meaning at the end of a trend, a market should display divergence, and that is the hallmark or telltale sign of the end of a trend. I view it almost like a law of physics for the market, like it has to be that way. The only question is really on what time frame that would happen. It may not be visible on every time frame you're looking at, but it will be visible on some time frame. And secondarily, when you see multiple time frames lining up with this type of divergence in price and sentiment and breadth, and I'll get into that in this video, the more likely you are to be seeing a significant turning point in the market here. So that's the first thing I'm going to start going over, is just some price divergences here in the market, and show you where we're at here in stocks. So this first chart is a chart of the S&P 500 here. This is the ETF SPY. And this is a monthly chart. So here's the tech bubble bull market peak back here in end of March 2000. Here's the October 2007 bull market peak here, and here's where we stand today. So just on a simple analysis here of the MACD, which is below the chart, we can see a couple things. A, the MACD has recently hit the highest point in history. And the MACD has both elements of moving average and an oscillator here, so it would make sense that as price reaches all-time new highs, in a similar fashion, moving average would reach all-time new highs, but it does oscillate around a zero line, similar to a bounded oscillator. And so we're actually seeing that there's really no question about it that we're at an overbought region in the MACD, so that shouldn't really be debatable based upon this. Now, secondarily, for the first time really in this bull market here, we're seeing the MACD overbought with divergence. And what I want to show is that the last two bull markets did end with that type of a setup here. So we're going to kind of zoom in at the prior two bull market peaks and show some of the significance here. So let's kind of cut out some of the other noise in the market and look at the MACD in 1999, peaking right here, pulling back to the moving average line, coming up, and as price made a higher high here in December of 1999, the MACD made a lower peak, and we had kind of a reversal in the market here. It ended up being a fake out with the market pushing higher a couple months later, but at that peak we did see an even lower peak in the MACD, and that was actually the bull market high. So our first real divergence signal in the market came in the S&P 500 at about 140-150, the ultimate top being 153, about 13 points off the high, less than 10% off the high. And really, if you would have sold out at here, there were only two closing bars, two closing bars above this peak here in the MACD, and this would have been one of them if you got out there. So that was actually a very good signal to get out of the market in terms of the bull market. The downside was obviously far greater than the upside at that point. Now, if we move forward to the 2007 bull market top, we see the MACD peaking here in June, dipping back just a little bit on a sharp correction into August, and then the MACD making a lower peak right here, a slightly lower peak, even as price moved higher in October on a failed attempt to break out here. So again, a MACD divergent signal, and that led to the bull market high, and that was really the only signal we got at that time in that bull market. There really were no failed divergent signals in the bull market there in 2007. So what I'm going to do is fast forward here now to the 2014-15 period, and other than this time frame back here in spring of 2012, where we did see a MACD divergence, bearish divergence, it was arguably not overbought. It wasn't at a new all-time high, so we're really at a more similar scenario up here. And the MACD peaked here in December 2014, had a slight pullback, dipped slightly below the moving average line, and then we've come up to a slight higher high, at least basis the S&P 500 cash, and the MACD has made a lower peak here. So we now have a divergence in the MACD, monthly MACD for the S&P 500. And I think this should be a very significant signal for us. If we see price move down here below the January, February lows, that could be used as a signal for a short in the market with a stop above the current highs. That could be used as a sell signal for the entire bull market or for investment positions. And while certainly there's probably always the possibility of a fake out where we see market break support and continue higher, understand the market, the trend will end at some point. There will be a top at some point, and whether it's going to be this month, whether it's going to be now, or whether it's going to blow even much higher, we don't know. But this would be a typical type of a signal we could use based on the price action here, would be to short at a break of that intervening price trough that created the divergence, and that would have been the August low in 2007. And we're looking here at the December, January, February kind of lows here in 2014, 2015. So that is the monthly setup. So we have a MACD monthly bearish divergence, at least the type that we've seen at the past bull market highs. Now I'm going to move down to a weekly chart here, and we can see very obviously that the MACD has been making lower peaks even as prices have been moving higher here. The peak in the MACD for the bull market actually came here in 2013, May of 2013, and kind of double topped here in early 2014, and then we've been seeing lower highs. So we do have another time frame, the weekly time frame, showing a very drawn out and relatively sharp angled bearish divergence here in the MACD. So we have two large-scale time frames showing us bearish divergence in the MACD and the S&P 500. Now moving down to a daily time frame, this is kind of an odd divergence here, but we do have a lower peak in the MACD here at this recent February high relative to the November-December highs. And it's not the most classic MACD. It would maybe be a more classic MACD if we saw another slight push, kind of a short-term double top here around 212 or 213 in the S&P 500 in the next couple weeks. That would probably be the most classic triple time frame setup, where we'd have a monthly, a weekly, and a daily kind of classic MACD divergences. But given the way these tops have formed in the past, with this attempted breakout here of the December 2014 high, we had this brief foray into new highs, and now a close back below that. As a just kind of a chart type of a pattern would be relatively consistent with a failed breakout and a final top. So I don't know that we're going to see yet another push to new highs and create that MACD divergence on the daily time frame. But the point I want to make here is that we are seeing this multiple time frame setup here, and while the last few setups we've seen have led to some significant declines, they have not led to bear market type scenarios, but this is the type of technical setup we should really be looking at for a bull market top leading to a bear market. And I do want to just kind of go over some other indications and other signs of divergence that indicate we might be at a significant high in the stock market here. So first thing I'm going to do is look at, this is going over to stockcharts.com, looking at the last several years of the bull market. This is looking at the new highs in the NASDAQ, and this goes back to 2012. And we can see that new highs in the NASDAQ peaked in 2013. And similar in the New York Stock Exchange, we had it peak in 2013 about midway in the year. And since then, even though we've had significantly higher highs for the bull market in price, we see that we're not having expanding 52-week highs in the actual number of highs, so in breadth in the market, and that's a pretty significant divergence. And even relative to the peak in new highs this past fall in 2014, as price made new bull market highs in late October and early November, we see the February top here not exceeding those peaks in new highs either, even though price did. So there's a pretty pronounced bearish divergence going on here. If you look historically at bull market tops, it's very common for the ultimate price peak in a bull market to be well after, maybe even a year plus after the peak in new highs. And so this would be relatively consistent with that as well. We're just kind of waiting for when that actual price high is going to happen, but the pattern is clear here that we've already seen the peak in optimism, and we're now in this long-term divergence or bearish divergence phase, and we're really just looking for kind of pinpointing that high point and either exiting investment positions and or entering short positions to speculate on a potential large-scale decline in the stock market. Going back to price chart here, want to look at some sentiment as well, and look at divergences in sentiment in the market. And I track sentiment in different ways. First thing we're going to look at here is the VIX. And if we look at the VIX is kind of a fear index in the market. It's looking at premiums in the options market, which typically expand as markets decline and fall as markets rise. And so it moves inversely to the stock market. So when the VIX is very low, as we saw it here in July of 2014, that would correspond with a stock market peak, which that corresponding peak in stocks here was July 2014 in stocks. So we saw the market rising as we saw the VIX falling into that point. But here we are, getting close to a year later, about 8 months later in the market, and the VIX, even as price pushed higher into new bull market highs in December of 2014, the VIX didn't make a lower low compared to July, and then even as we saw yet a higher high on this recent breakout in February to new bull market highs, the VIX did not move below the December or below the July. So we have this again, non-confirmation or bearish divergence in the VIX, in the underlying volatility, which is a real money measure of sentiment in the market, in the options market here. And so this would give us a relatively large-scale bearish divergence, in addition to possibly a shorter scale VIX divergence that we sometimes see right at the ends of a leg up. We're not really seeing that type of divergence displayed here within this recent rally, so it is possible again that we might see that more classic divergence type of pattern occur, like I had mentioned on the MACD chart. But in any case, the setup is very clear here that a large-scale divergence pattern is in play in volatility. Now, next thing I'm going to move over to is put call ratios, and the minimum of the put-call ratio, and I'll look at a few different average here, but occurred right around New Year's 2014, so about a year and 3 months ago now, or a year and 2 months ago now. And since then, even though the market has made higher highs in that June, July 2014, December 2014, and here into February, the put-call ratio, which also moves inversely to the stock market, has not made lower lows. So it's again a bearish divergence or non-confirmation for the stock market. And if we look at it kind of a longer-term moving average of the put-call ratio, we can see it more smooth here, that even though price has been going up in this time frame, so again the peak in optimism or the trough in pessimism, given the put-call ratio is back at this level, and then we've seen the market moving higher, we have not seen the put-call ratio moving lower. So there's a relatively large-scale bearish divergence in the put-call ratio at this point. Another thing I want to look at here is the McClellan Oscillator, which is a measure of breadth in the market. And well, we already kind of looked at this in terms of new highs. This is kind of another smooth way to look at that. But the peak in after the big correction into October of 2014, which would be this point in the market back here, this low in the stock market in mid-October, correlates with, where are we at here? Correlates with this point in the McClellan Oscillator, right in here. And then we saw this ensuing rally, which had been making higher highs all the way into February, but the peak in the McClellan Oscillator occurred back here right at the end of October 2014, and even as prices made new all-time highs into December, and then again in February, we didn't see the McClellan Oscillator making higher highs. And then the peak in the S&P 500 was February 25th, and the McClellan Oscillator was all the way down here, relatively close to zero, and then by the 27th, the McClellan Oscillator already closed below zero, so just a day or so later, which would be, yeah, just 2 days off the high. Here's the 27th. So that's a pretty sharp bearish divergence in the McClellan Oscillator. And when the market is peaking, well, the McClellan Oscillator is basically at zero. That type of a pattern occurred there in September of this past year, leading to that very sharp decline in the stocks into October, which was the biggest decline in 2 years in the market. And so we're at a not real dissimilar level here, though the McClellan Oscillator divergence isn't quite as pronounced as the market was topping here. So if we see, again, another push to new highs in the market here over the next couple weeks, let's say we get up to around 213 on the S&P 500, and we then see the McClellan Oscillator rallying up but failing to even cross above the zero line, we would probably have a triple time frame S&P 500 MACD price divergence, and then we would have just these continuing kind of massive drawn out divergences in sentiment and in breadth. And if we do see that type of a setup, I would not hesitate to short the market or purchase put options for several months into expiration for the market. So let's just say that scenario does occur and we see a peak in March in the S&P 500, then I would look out into May to September or October for the put options. So let's say we peak somewhere in this level here, potentially look at a May put option purchase somewhere around that 213 strike, and the other option being looking for the typical seasonal low, which often occurs in the September-October time frame, possibly even buying a put option somewhere at those strike prices on a break to new high, expecting it to fail, and possible significant downside risk into the fall of this coming year. So those are just some longer term options there if we do see that type of a setup develop. So that's the main price pattern I wanted to point out here for the S&P 500. Now, given the chart scenario here, I do want to point out some other things that I think are significant. And I'm going to move back to some of the stock index charts here and look at the Russell 2000. So this is the Russell 2000, and we've seen price move slightly above a prior triple top here in February, and then it's seeming to fail, coming back down and closing below that triple top. One thing I think was very significant here, if we put a volume study under the Russell 2000 and look at a 4-week average volume, and let's move to a weekly chart, we can see that the actual weekly volume is the lowest it's been in the entire bull market, as price is trying to break above a year-long consolidation here. That's probably not a great sign for the breakout when you have like no volume going into that breakout. And additionally, if we look at this weekly time frame here, we can see there's this weekly reversal bar where price made a new higher high, reversed down and closed way at the lower point of the range. And if we move that down and look at a stochastics study here, we can see the stochastics made a bearish cross from overbought territory. And if we see price make a lower low, so just below this week's low in the Russell, that would be a sell signal for the stochastics, and we can short, either exit longs or short with a stop above this high, and then we would short and be looking to wait for the well, in worst case scenario, get stopped out, or best case scenario, wait for the stochastics to start to roll down here, and then we'd want to see a daily time frame divergence type of pattern, or at a bare minimum a bearish a daily time frame oversold signal in the stochastics, and then looking for that stochastics to cross back up here. So there could be at least several days more decline at a absolute minimum, just given a typical kind of dual time frame setup here in the stochastics on the Russell. Moving over to the New York Stock Exchange, kind of a similar scenario here, that we have kind of a triple top between July 2014, September 2014, and November 2014. Price poked above all of those tops to a new all-time high for just about 2 days, and then has pretty dramatically reversed lower here over the last few days. And this may not be a good sign for the New York Stock Exchange. So we have an inability of it to hold the breakout, despite the NASDAQ kind of leading the way and so far managing the breakout. But all the other stock indexes, SPY is closed back down below its December breakout. New York Stock Exchange well below its breakout point here. The Russell coming right back down, slightly below its December breakout point. And we have the Dow over here as well. Dow coming back below its December breakout point after a brief foray into new highs. So it's really only the NASDAQ at this point of the major indexes that's able to hold up, and that would not be atypical for a bull market top either. In the 2007 bull market peak, we did see the NASDAQ top around a month and a half after the other indexes, and it was showing relative strength. The other indexes had a more classic kind of failed breakout and topped a bit earlier than the NASDAQ. So something interesting on the NASDAQ, if we look at the NASDAQ composite monthly chart, we're just within a few percent here, about 5% of the all-time high in the tech bubble. It might be kind of a cruel trick if we got this close and didn't break it, but I certainly think there's a possibility that the market does peak here and doesn't actually break that high. I think it would be more classic for it to break that high and run that level prior to a major correction or bear market ensuing, but it might be just a interesting and kind of tricky way for things to top, given that high is in sight, and if it never gets hit, it would be relatively similar to how the silver market peaked in 2011, going back to silver's high in 1980, came within just a fraction of breaking a major all-time high, and didn't actually exceed it, and then has undergone this just massive bear market since then in silver. So I think there is some precedent in other historical markets that we could get close to a major kind of blow-off high in a market without touching it, and then set the stage for a major decline. So just an observation based off of some other market dynamics there. So those are the main things we're looking for here in terms of the overall technical setup in the market. And one thing I did want to point out in terms of the financials is that in a healthy market, the financials should lead, or at least that when financials have not led, that has been an indication that the market may be at risk of some downside here. And so currently this is the U.S. Bank Index, and while we are seeing in February the rest of the market moving to higher highs, we see this banking index not able to break above the December highs, and it's had this kind of long-tailed hammer or shooting star reversal and a candlestick pattern right in a very significant, perfectly overlapping Fibonacci confluence area, which on this chart is around 327 in the bank index. And given the non-confirmation in the bank index, this kind of down and then ABC pattern into a confluence zone on the Fibonacci, price retracement level, and the tendency for financials to lead and not confirm at the highs, which we also saw if we move back to this was March 2007, and the bull market did not peak until October 2007 here. So the bull market peaked here, but banks peaked back there. And on this chart currently, this level corresponds to this level, which was still a couple months before the bull market peaked. But in any case, it's an indication that possibly we're in the final stages of a topping pattern here in the stock market overall, and financials may be set to lead, and financials may very well have made their peak. So along that line, what I want to look at here is the XLF ETF, and while it doesn't show the exact same pattern as the bank index there, it's very similar with the stock indexes as a whole, making higher highs here in February. The bank index fell well short, and here we are with this kind of wide range reversal bar where it broke above some horizontal resistance at this 2450 level on XLF, ran the buy stops up above there, and then reversed down to close at the low end of its range. If we just throw a Bollinger Band in there, if we see that kind of pierce the upper Bollinger Band, which it did, we have this touch of the upper Bollinger Band and a reversal there. That's kind of a nice, kind of a classic pattern here. And we also have this stochastic kind of bearish divergence where the stochastics is turning down. So in my opinion here, this is actually a good short on the financials. And what I would be looking at here is for financials to sell off probably in relatively rapid fashion below this February low. And I would think that that's going to occur prior to May option expiration, which would be, let's just get a vertical line on the chart here. So May option expiration would be somewhere around here. And so obviously it would be very feasible for price to come down and break this low here prior to May option expiration. If we just kind of compare that magnitude of a decline compared to some other declines here, it's certainly possible. All right, and I'll just go ahead and draw that line to the actual May expiration and show you that given some of the other corrections in the market here, that would be a sizable correction, but it also would certainly be a relatively normal significant correction for a bull market. But given the fact we could be seeing a bull market top, and we could be seeing kind of a bear market type of price action unfolding moving forward in XLF, would not be uncommon to see a relatively rapid decline there. Personally, I'm looking at buying a May 25 strike put in XLF at the beginning of the upcoming week. Let's see, let's move here. So this is the May expiration put. This is XLF here. So the 25 put's trading for about $1.15, which means we would need to see price at about $23.85, right in this level here, in order to break even by May expiration. That's obviously not a real big move down, and we would only need to see price get down to around 22.70 in order to create a 100% gain or have a greater than 1-to-1 reward to risk ratio here. So if we did see price come down and break this February low, as I've suggested here, that would be about 100% gain on the option, and I think that's very reasonable for that to do so. Also, purchasing the 25 strike, price would have to rally up above here by May expiration in order for the option to lose 100% of its value. So, well, it's certainly possible. Price could make a nice gain here. If price is losing momentum, as these divergences suggest, even if we chop around here for a couple weeks and then start to falter, this option may not expire worthless, even if we don't see an all-out decline here, as I think we are, maybe likely to see here moving forward in XLF. So that is one option of how to maybe make a speculative play in the options market here on XLF. So that's the main information I wanted to cover here. I thought about reviewing some of the kind of recent market calls I've made on the blog here. Yeah, I think I'll save that for another time. And I guess I just want to impress upon anybody following this blog and these videos that over the past couple years in this bull market, there has been an unprecedented type of an event occurring in the Federal Reserve and in the kind of the banking industry and the injection of liquidity and whatever the heck that means in a market on a fundamental level, but the keeping of interest rates low, the lack of raising interest rates despite a roaring bull market, and in past bull markets when prices have gone up, the Fed has tended to raise rates there, but since we're not seeing kind of fundamental inflation, we're actually seeing the opposite. We're seeing declining inflation where there's very little growth in asset prices and economies around the world. The Fed has not been raising rates, and so there's just been all of this liquidity going into the market, and that may be why, given some of the signals we've seen in the past in stocks, where we might have expected a bull market to peak, given the technical analysis maybe in 2012 or even in 2013, why the market has just kind of steadily been able to move higher here for a couple of years. But my opinion is that this can't go on forever. Cycles will take hold. Things can only be delayed and probably made worse in the long run in terms of the ultimate kind of reaction to the fundamental nature of what's happening in the market there. It's like you can only cover things up and bandage them and not actually let things run their course for so long before just a catastrophe happens, and we might be kind of on the brink of the at least price high of that happening here. So that's my current take on it. If this does end up being a bull market top, this will be a pretty good call, as we're only about 1 week off of the bull market highs here, and the NASDAQ did just make a bull market peak this week. The QQQ, the Dow, if we also move to the Dow here, also made a bull market peak this week and formed a strong reversal bar. So if this does end up being a bull market peak, it'll be a pretty nice call here. And given the just some of the longer term sentiment measures and longer term levels of leverage occurring in the market in both futures and just margin. Those are at all-time highs, at least on New York Stock Exchange margin, and I'll probably get into some of the COT data and kind of look at that here, but understand that the market has moved higher with massively increasing leverage, and anytime the market moves higher on leverage, when it falls, the falls will tend to be dramatic. We don't have to look anywhere beyond crude oil to understand that, and maybe that's even worth pointing out right now, so let me just go ahead and do that. And I might actually go back to my blog here a couple years back. Let's zoom into crude oil here. I just want to kind of get an understanding of what it means when you see markets building up a massive amount of leverage there, and the type of declines that can take place. And so let's go back to April 2011. Let's go back to January, February 2012. I just want to look and see what I was putting on the blog there. So February 2012, oil update, made a video on that. Let's go back into April 2011. Okay, not finding what I'm looking for here. I'm sure on that video in the 2012 section that would be covering some of what I'm looking for, but let me just kind of verbally go over my point here. Here we see the all-time high in crude oil in July of 2008, and as we saw a huge decline, just this massive sell-off in crude oil, where we had this huge buildup of speculation in the market, and then we see a crash as that speculation and that leverage unwinds. On this rally back up to the highs in 2011, we actually saw the net long position in the futures market in oil actually exceed the amount of net longs that there occurred at the bull market high, and yet it was at a lower top. And one of the points I made at that point in time was that just the logic of that, meaning that we have a even greater amount of speculative accumulation with price not even making a higher high. If we get any type of a similar unwinding of that amount of contracts in the futures market, that we might see price make an even lower low in like an A, B, C type of a fashion, and actually take the market back below these 2008 lows. So that was the point I made at the time, and obviously that seemed kind of ridiculous. And while we did get some, a significant decline there in crude oil over the upcoming months, it turned into this major consolidation period for around 3 years there, and I kind of stopped updating too much on crude oil. Although I did make an update here in, let me go look at that May, June here of this last year. Let me zoom in here. Apologize for this. I just want to kind of go through this in detail so you can kind of see things as they happen real time and kind of make a point of this. Yeah, let's look at May or June there. This wasn't a planned part for the video here, so just bear with me. I think it'll be instructive just to kind of look at what's happening in oil, so you can maybe understand what could potentially happen here in stocks. Well, I guess I'm not finding what I want to find here, so I'll just continue on with this verbally, so pardon for the interruption there. Going back to that weekly chart here, as we saw price moving into this June high here in 2014, we actually saw another new all-time high in the amount of net long contracts of large speculators in the futures market. And so this was the greatest all-time accumulation of crude oil in a speculative manner in history. Yet it was at below the all-time high and even below the recent consolidation. And that's just kind of a telltale sign that you're setting the stage for a massive liquidation. So if you see any type of significant price break, that's going to start to change the trend there. And since that oil was bought on speculation and on leverage, and in the futures market typically about 20-to-1 leverage, when you see that unwinding, you just can have some very dramatic price declines. So I think that given the stock market, that the market is pushed high on very largely expanding margin. There's very low cash in terms of on the sidelines for mutual funds and that kind of thing, and we're seeing kind of a drawn out net long by funds and speculators in the stock indexes as well, that we might be set up for somewhat of a similar scenario in stocks. And it's always kind of a crying wolf until it happens, but I just think there's so many signs here that to not protect yourself at this point, or at least pare down longs or have an absolute strategy in place for protecting the stock market, that you need to have that in place to protect your capital, much less to speculate on the downside. So that's all for this update. If you have any questions or any more specific analysis you'd like, leave a comment on the video or at the blog, and I will try and include that in a future blog post or video update. Have a great day and all the best to your trading.